Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. Our guest today is Anshul Saigal of PMS Johnson right now with his thoughts on how does he see the broader market outperformance relative to what the markets have done, earnings growth in light of the fact that the volume growth hasn't been as strong as maybe anticipated, and what does all of this mean for a very busy second half of the financial year. Anshul, great having you. It's been a while. Thank you for taking the time out.
It is absolutely my pleasure, Neeraj. Thanks for having me, and good
The
morning to
pleasure
you.
is ours. So, Anshul, how do you look at the markets? I mean, I would love to understand, is the bent of your portfolios towards the broader end of the spectrum where the rally has been? And if so, are you constructive even now on what could happen for the rest of the financial year, or are you guys turning a bit cautious given what's happening globally as well as the valuations in India?
Neeraj, we are about 65% small and mid cap, and that tells you that we are towards the wider spectrum of the markets. And our style of investing is that we try and take as few market calls as possible. Our endeavor always is to identify opportunities which are trading below their intrinsic value and where there is a mispricing in the market, which we understand. And we also understand triggers for value unlocking. Now, what happens in this sort of a framework is that in the odd case, your thesis will go wrong. But if you're 9 out of 10, if you're right, then you're home, and it prevents you from taking macro calls. And as we have seen in recent times, particularly the last 3 to 4 months, if someone was bearish, given the uncertainty in the markets, they have missed out on opportunity. We get prevented from being in that situation by being bottom up. Having said that, of course, we are followers of valuations, which means that if valuations go out of whack, then that's when we try and take somewhat of a defensive call. And we do believe that there is a lot of skepticism in the market still, and so this rally may have some more room to go, although valuations are stretching on the sidelines basically at this moment.
Got it. Anshul, if you can hear me clearly, where is it that okay, here's my question. Typically, when you look at intrinsic value and discounts thereof, some things might last for a really long time, and you're not buying for 6 months, 9 months, 12 months. So, where is it? Or rather, do you believe your portfolio is still primed for making portfolio gains over the course of the next 20 to 24 months meaningfully?
Again, Neeraj, what we are very keenly watching is earnings growth, and there are certain pockets where earnings growth is still is going to be significantly ahead of market expectations, and there are certain pockets where the markets have run ahead of themselves. So that's where you have to be cautious. And if anything I've learned over the last 20 years being in the markets, it is that if you have earnings visibility, then that's where markets will continue to reward you on those names. And so we are very disciplined in identifying companies where there is earnings visibility and there is clarity of earning power over a period of time. As long as we've got that in place, I don't think that we need to worry too much about what's happening on the macro. And more times than not, if you're watering your flowers and cutting your weeds, you're in a good place. And that's what our philosophy is: let the winners ride. And where there seems to be some problem which the market anticipates, that's where that's really where we will trim our positions.
Okay, Anshul, standard part of all of my shows is that we do not ask guests for recommendations. So anything that we talk about, viewers, I urge you to think of it as illustrations to understand the thought philosophy that Anshul and his team deploy when they are making the bets that they are making. So please keep that in mind. Now, Anshul, I heard you make two very interesting things. In the first answer, you said in certain cases, there are pockets which may have run ahead of themselves. But I also heard you say that you're watering your flowers and you're letting the winners run. So I'm trying to understand what are those pockets wherein there has been a significant uptick from the time that you may have bought in, or in the last 6 months, as the case may be, but where you still believe that earnings growth or even a valuation uptick from where they are right now could well hold them in good stead for the next 24 to 36 months or 12 to 24 months.
Um, there are certain pockets in the markets, Neeraj. Let me give you an instance. We were buyers of the largest cables and wires company um, post the IPO, and for the longest time that company went really nowhere. This is sometime in 2018 and 19. Now the price used to rule at about $600, and we could have sold it at 800,000, 1,500, 2,000. Even as recent as the last 6 months, we could have sold it at 3,000. The stock is 4,600 to 4,700 rupees today. Now, the point here is that we continue to see that there is earnings triggers in this name, and that expectations are only chasing real earnings. As long as that kept happening, we continue to hold, and the stock has done exceptionally well for us. Similarly, we think that at this moment there are certain capital goods companies where the earning power is yet not reflected in their existing earnings. What I mean by that is that in the recent past, they've done somewhere close to 5 to 6% EBITDA margins. And our assessment is that their earning power is to do 8 to 10% EBITDA margins. Some of that has started to get reflected in their earnings in recent times, in recent quarters. And when that plays out, these names which look slightly expensive at this time will not look so expensive. And as a result, there will be value unlocking in these names. That is our endeavor. Rather than focus on where there is, whether the price has run up too much, our focus is to understand whether expectations are still chasing earnings, and earning power is significantly greater than current earnings.
Okay, I'm gonna cite some instances in the market, and I would love to understand whether you guys have views there or not, whether you have some thoughts out there or not. So, the railway bucket, we've seen tremendous order inflow. The book-to-bill ratios of these companies are very strong. Earnings growth of the last 2 or 3 quarters has looked very robust, but the price uptick has been very, very significant. How do you characterize this bucket, if you have thoughts here?
Neeraj, you being a veteran in the market, understand that there are two aspects to a stock price. One is the earnings, the other is the perception of earnings, perception of future earnings, which is the price to earnings ratio. Now, these same companies, I could name one company which was there in our portfolio, which had revenues of 10,000 crores, an order book of 75,000 crores. And this company for the longest time was trading at 5 times earnings, about a 5% dividend. And of late, it has gotten re-rated to significantly higher levels. It's trading now at 5x of the price that we bought it at. And now that this has happened, our belief is that much of the easy money has been made, and now, if at all, expectations should be tempered to earnings compounding. As earnings compound, so will be the performance of stock price. Such re-rating of multiples is behind us. And we believe that this is the case across across the railway spectrum. There will be 1 or 2 companies where there will be significant beats on expectations, and hence multiples will have further upside. But by and large, the multiple uptick has played out.
Would the same case hold true for PSU banks? I know they're still, you could argue, maybe in certain cases, discount to their 15-year averages, but they've moved up a little bit both in the price to book as well as the earnings term. So I'm just trying to understand, any thoughts on PSU banks?
Again, yesterday I was speaking to someone about PSU banks. We have participated in this rally, and there is somewhat of, in fact, there is substantial uptick in multiples that has already played out. From here, I mean, there will be a differentiation made between PSU banks. PSU banks where leaders can communicate well and who continue to show uptick in earnings growth. It is those banks which will start trading at a premium on book. Other banks where, I mean, in general, I believe that there is going to be significant tailwinds in the banking space. Credit growth is at 15 plus percent, even on a high base of last year. And so PSU banks will be in general beneficiaries. And NPA cycle has peaked. So they will be generally beneficiaries. But the differential will be how they communicate. And banks that communicate well and indicate to the markets that their ROE trajectory is steadily and consistently on an uptick. It is those banks which will see further bouts of re-rating. All the others will see compounding in line with earnings.
Got it. Where is it, Anshul, that you believe that there is a case of both multiple re-rating as well as earnings growth potential, even in a market which is trading circa 52-week highs or life highs?
I'm too used to calling sugar companies, but they are no more sugar companies. They are actually ethanol companies, which also do sugar, and sugar is an input into the ethanol business. Here, I think that the dynamics of that business has changed so dramatically that we will see both earnings uptake as also we will see multiple expansion in this space. And this will play out in our judgment over the next 2 to 3 years. And when the street sees that earnings are consistently on an upward trajectory, these companies which are trading at 6, 7 times earnings, they will have no room for the multiple to go but up. And so our belief is that that this space will do well. Pharma, I think what played out over the last 6, 7 years. In fact, this segment of the market has gone nowhere for the last 7, 8 years. And here, what we are seeing is two interesting things, which you can't really put on Excel sheets for now. It is just a judgment call, which is that there are shortages on US racks of generics. And at the same time, there are significant price cuts that the regulator over there is imposing on many of the exporters of generics from India. Now, both things can't go on indefinitely. For shortages to go away, prices have to go up because it has to be remunerative for companies to actually go out and manufacture. And our belief is that that cycle is going to play out now over the next 1 to 2 years. If that is the case, where companies have consolidated over 6, 7 years, we will see multiple expansion. Some of that we have already seen, but our belief is that there will be further tailwinds to this multiple expansion, particularly in exporters to the US. India business of most companies continues to do very well. So these are two pockets where we see opportunity. And then there are, of course, ample and umpteen opportunities, which are bottom-up individual opportunities, even in sectors where froth may be developing.
Just one follow-up out there, if you will. Excuse me, I was talking to the largest sugar company yesterday, and in their case, maybe the capacity expansions are already in place, so you don't know how much of further capacity can come on stream. So would you be choosing companies which have capacities coming on stream at multiple points of time and thereby the earnings growth happens? Or do you reckon there will be realization uptakes and therefore earnings growth happening even in companies wherein all capacities have come on stream?
Both are different issues. Let's look at both issues separately. Let's look at the capacity expansion issue. Our belief is that many companies have already set up ethanol capacities, and they have expanded both sugar and refined sugar capacities in recent times. And so what we will see is greater utilization of this capacity in the current sugar season and the next. And as a result, ethanol profitability will go up meaningfully. Now, the largest listed sugar company that you speak of, that company, just for your I mean, just for the viewers' reference, till about four odd years ago, they used to make 300 to 400 crore EBITDA just from the sugar business and nothing from ethanol. Our belief is that in the next 2 years, they will make the same amount of EBITDA from sugar, but from ethanol, they'll make about 7 to 800 crore EBITDA. So the scales have tilted in favor of ethanol, which is a much more stable, steady cash flow business, where margins are kind of guaranteed by the pricing mechanism. And as a result, profitability will go up meaningfully. Now, on sugar realization, what we are seeing globally is that there is a significant shortage of sugar. India being a dominant player, if India's production gets cut and also India doesn't export to the global market, there is significant shortage in the global market, and as a result, prices do move up. In recent times, prices have moved up from 17 cents to as high as 27, 28 cents. And there is only upward pressure on sugar globally. If there is a failed monsoon, and as we all know, sugarcane is a water-consuming crop, then there is further shortage of sugar. As I also mentioned, if India stops exporting because this is the election year, again there will be shortage of sugar globally, and there will be upward pressure on prices. Take that all into consideration. Our belief is that both on price uptick as also on capacity utilization, there is going to be upsides in cash flows in this business, and the street really is not building in yet what can happen in this space over a period of time.
Got it. One last question, Anshul, because you mentioned pharma. This quarter, I saw a peculiar trend in the other exporting complex, which is chemical stroke specialty chemicals. In that, the stocks did not react too adversely to weak numbers, which kind of suggested that maybe sellers are out of the system because nobody owns these stocks anymore. And the commentary from some of the companies seems to suggest that maybe there is pain for a quarter or two or three, but things might be turning around globally. And once the global demand improves, these companies might also materially improve their operations relative to the basis that they're clocking in the last 12 to 18 odd months. Is there a case for looking or relooking specialty chemicals, or is it some time away?
You've actually kind of hit the nail where we are actually doing some work at this moment. And our belief is that this year will be another tepid year for earnings growth in this space. At the same time, there are multiple chemicals companies who have corrected between 30 and 50%, in some instances even more. What we saw last year is raw material costs were elevated because of the Ukraine war. This year we are seeing those costs coming down, but volume pressure being there, and as a result, many of these companies are, they're languishing where they are. But our belief is, of course, we have to do more work, but our belief is FY25 can be a far different year than FY24. And as we know, markets are forward-looking. It is for that reason you're not seeing, even on weak results, many of these companies correcting or stocks correcting from current levels. Also, much of the fraud is already out because these names are down 30 to 50%. So for FY25, we see earnings tailwinds, at least for now. And we do believe that at some point in this year, this space will become attractive to look at.
Okay. Well, that is really interesting to know. Thank you for being so candid in this whole conversation and giving us a real good sense without being predictory, if you will, into any of these things, Anshul. Great talking to you and look forward to talking to you more often.
My pleasure, Neeraj. Thank you for having me. Thank you very much.
Viewers, thank you for tuning in.